What's up, everyone? Welcome back to the Loose Ventures channel. Got another video for you today. This one is on an actual deep value electric vehicle play, and the stock is Stellantis, ticker STLA. So this is a stock that I've mentioned in a previous video, but I thought I'd give it its own video following the structure that I outlined last week with the 4 steps to my stock analysis and valuation process. So I'm going to go ahead and apply that structure to Stellantis, give it its own video because really I think it deserves its own video. But that said, let's get right into it. So Stellantis, for those who don't know, Stellantis is one of the world's largest auto manufacturers. It's number 9 last I checked. And they recently became the product of a merger between Peugeot and Fiat Chrysler. So these are all the brands they have, a bunch of legacy brands, and some of the brands they're really pushing forward with the electric vehicle growth strategy that the new CEO is trying to affect. So you'll recognize some of these brands: Fiat, Jeep, Dodge, Opel. That's kind of the whole, I guess, story of Stellantis. This is sort of a transitioning point for them. They already started pushing into the EV market. They're I believe the 3rd biggest in Europe, and they're actually catching up to Volkswagen in Europe right now. So they're pretty big. They're trading like a cigar butt. They're trading at very low valuations. Nobody wants to touch them for some reason, based on the price. But yeah, I think it's a very, very interesting time, very good time to take a look at them. So let's get right into it. So as I mentioned in the previous video, want to talk about the 4 main steps to my process. First one being financials. So as always, first part of financials, I want to look at estimates. So here's ticker.com, and always want to look at revenue, EBITDA, and free cash flow. So this is going to be very forward-looking because of the merger. By the way, it's not going to make sense to look at the 2020 and before. This would be very forward-looking, but this would be heavily focused on valuation. So here we do see some good revenue growth coming off of this year, double digits, and the next year it moderates, which is perhaps understandable. EBITDA is $27.6 billion down to $25.7 billion. Still decent, 14% margins, not bad for an auto manufacturer at least. Free cash flow, $7.66 billion expected next year, coming off of $8.8 billion for this year. So auto manufacturers in general are expecting lower profits for the next year or so. That's just because of the semiconductor chip shortage, global demand, global recession that is surely coming, if not already here. So estimates look okay. This is really what's really going to be important would be the valuations. And the only other thing I want to check, just want to make sure that these have a good number of estimates. These are all coming from Bloomberg, by the way. So 22 estimates for revenue, 19 for EBITDA, 12 for free cash flow. So that seems fair. That seems decent enough for me. So let's go over to financials. So we already looked at free cash flow. That seems okay. We can't really look back too much. So here, I just want to check operating margins, 10.6% last year, 11.7% last 12 months, which is expected to drop a little bit, perhaps around 10%, what with the issues that the entire industry is facing. EBITDA, $22.3 billion to $24.5 billion for the past 12 months. Okay, so not bad. Balance sheet. So let's check the boxes for liquidity and leverage. Liquidity, current assets, $83.3 billion, divided by current liabilities, $70.1 billion. So that's about 1.2 times. That's over 1. So that checks the box for me. Good liquidity, just high level checkbox, right? By the way, almost $50 billion of that is in cash, which is crazy. So going off of that, let's look at leverage. $29.6 billion in total debt over the past year. So they have $20 billion in excess cash. no net debt. So keep that $20 billion dollar figure in mind. And as we look back at the valuation. Statement of cash flows, just to kind of polish off the profitability section. Cash from operations positive. So, again, we're just going to be forward looking mostly. And we just want to look for red flags here. I don't really see anything in particular. Acquisition that was part of the merger. And they'll probably have some good capital expenditures moving forward relating to the growth strategy and bolstering their competitiveness in their markets. So that's definitely expected, but their free cash flow, or their cash from operations rather, it seems pretty sufficient to handle some pretty high capex. 8.4 billion capex right there versus 24 billion cash from operations. So that could drop by a pretty good amount. They'd still have a lot of cash to invest in themselves and the growth strategy. So okay. So that's all I'm going to check here. Again, not much to check looking back. So that's I guess high level financials. They're just profitable, right? And this is going to be heavily based on valuation. But first, before we go into valuation, let's look at the risks and potential catalysts. All right, so this is a summary I made for myself. Just updated this today, and I put this in kind of like dark mode, just in case you're watching this later in the day. Hopefully it's easier on the eyes. So this is just a note I made to myself. Stellantis, a potential cigar butt trading well below comps and book value. My summary is Stellantis displays traits of a classic potential turnaround story, but with far better financials and valuation than typical cigar butt value plays. While Stellantis is beginning to chip away at Volkswagen's market share in Europe, significant strategy execution risk remains pertaining to Stellantis' relatively late push into the EV market, its main competitors being Tesla and Volkswagen. This plan may need a boost with strategic battery manufacturing related acquisitions, which would bolster Stellantis' competitiveness within key North American and European markets. An update to this is that management recently stated the intent to improve in-house capabilities, which may include battery production. I hope it does, as a matter of fact. Financials alone imply that the current valuation prices in considerable downside risks while significantly discounting upside risks. Viewed alongside an expected dividend yield of around 9%, expected mind you, and sizable share buybacks, up to 10% over the next few years was recently announced. For myself, I'm encouraging myself an immediate buy, but I would prefer to take a cigar butt dollar cost average approach. In consideration of this, lower overall market prices due to a weakening global economy may provide a very attractive double down price. It could take anywhere from 2 to 5 years for Stellantis to prove its current valuation is unjustified, which is entirely dependent on strategy execution. So a long-term investment time horizon is what I'm expecting. So these are just notes I make for myself, and this is just a summary of all the notes from all the sources all the notes that I've gathered. So this is a long-term investment. This is pushing it for me because typically I cap out at 2 years, right? But I'm hoping within 2 years I start to see some good progress and I can update this thesis. So the overall thesis is the company is in transition. They're going from some legacy brands. They already have a good start in pushing towards electric vehicles. They're starting to capture more market share from Volkswagen. They outsold Tesla in terms of fully electric vehicles in the first half of 2022. So there's some good signs showing up. Now, let's go to valuation and let's see what's going on with this stock relative to its comps. So I included Volkswagen, BMW, GM, Ford, Toyota, Honda, and of course Tesla. Tesla is going to stand out quite a bit because their valuation and because they're Tesla. So I put in all the projections from earlier. I conservatively assumed some share buybacks for only 3 companies. Those are the only ones that actually buy back shares. Toyota and Honda being the other 2 aside from Stellantis. I only put 2% for Stellantis versus the 5 to 10% that they mentioned. And and that's going to be part of their plan, right, over the next couple years to repurchase a good amount of shares. So let's look at the multiples now. Let's see. I think Google's kind of messing up a little bit here. Let's see. Let's find the share price real quick. What was the closing? 11.93. We'll just say closing 11.93. All right, 11.93. Okay, good to go. All right, now let's look at these multiples. Main ones I want to focus on right here: enterprise value to EBITDA and free cash flow yield. Free cash flow yield is the sexiest multiple to me. That's the one I focus on the most. Enterprise value to EBITDA, 0.41. You just compare that to those other ones and see just how drastically lower the markets are valuing Stellantis versus all these other companies. I've mentioned this in other videos. I use enterprise value versus market cap. It's just more accurate representation of what the company is worth. It's just market cap, less cash, plus debt. So this is the potential price of the company should another company want to acquire it. Just industry standard is all. So here you can see it's priced way cheaper than all of its competitors. Free cash flow yield 72%. My hurdle rate is 5%. So this is insane. This makes me very happy as a free cash flow yield investor. So this is obviously way higher than its comps. And dividend payout ratio, or not the last thing because we'll still talk about that, but dividend payout ratio, I actually compared dividends to free cash flow. And their dividend might not be the same. That was a trailing dividend. I believe it was an extraordinary dividend because of the merger. But analysts are actually forecasting a similar dividend going forward. So we'll see. It's going to be variable, but we'll see. Honestly, I don't even need the dividend for this to be a deep value play. That's not mandatory for this play. But now actually the last thing is debt to EBITDA. So remember that $20 billion I told you to keep in mind. That's their excess cash. So they have 1.15 times debt to EBITDA. Look at the debt to EBITDA levels for all these other companies. Not even close. 7.1 times for Ford. So this includes all debt obligations, including financing arrangements. I did that just to keep this high level and keep it simple. You can subtract out the financing arrangements if you want. The debt levels are still going to be way higher than Stellantis when comparing them to each company's EBITDA. So that $20 billion excess cash means they have no net debt. Their market cap is about $38 billion for 2023, which is where these projections are coming from. That's going to drop their enterprise value down to $10.6 billion. So that's just so much smaller than all these other companies, yet they're still the 9th largest auto manufacturer in the world. So this is a little crazy to me. I don't know why the markets are pricing this stock like this. It could have something to do with the legacy brands that it has, but the way I see it, a lot of auto manufacturers have legacy gas-powered cars, right? And Stellantis is already like number 3 in several of its markets in terms of electric vehicles, So they're catching up. I think it's a matter of time before the markets start pricing them fairly because they're not doing it right now. So potential catalyst. Let's say there's a recession in Europe, or there probably already is, right? Asset prices drop. Stellantis has a ton of cash to make some interesting acquisitions, right? So they can improve their manufacturing capacity. They could buy a battery manufacturer, all sorts of things to help them catch up, while these other companies are too busy servicing their debt load and they're really worried about their EBITDA, And we can drop all of these figures by a good amount and we'll see what happens, right? Look at these debt figures. If we cut their earnings in half, it's crazy. But if we cut Stellantis' earnings in half, 2.3 times, that's under 3 times. That's good to go for me, right? Still 26% free cash flow yield. So 50% is a pretty damn big haircut, mind you. I don't honestly expect that to happen unless, things are looking real bad. But point here is just that Stellantis is very well positioned to capitalize on decreased asset prices to try to speed up their push into the electric vehicle market. So they're already doing a decent job so far. They got good management. They got a good footprint. They're not in China yet, which is seen as a risk. I see that as an opportunity because at some point they will expand into China. So it doesn't really make sense to me to see that as a risk. Surely they'll get into the Chinese markets at some point. So yeah, in terms of valuation, it gets all the green check marks for me. So I guess lastly, we cover financials, risks, potential catalysts, valuation, potential trades. I am looking at getting assigned some shares, and I would like to build up the position. I'm selling put spreads, mind you. I would like to build up the position. I kind of hope the stock price does tank because I'm going to load up on shares if that's the case, and that might speed up my investment time horizon. So if there's a big recession in Europe, asset prices fall, I'm loading up on shares. They're probably going to pay some kind of a dividend. They'll keep repurchasing shares. I'm sitting pretty on those shares. I'm also looking at January 2024 calls, looking at some leaps. It's going to take a while. This is a long-term investment. So I don't expect anything to happen too quickly. And big global recession is kind of in the way, right? So that's what I'm looking at. Long-term, at least a couple years. And I'll be updating this probably every earnings report. I think their earnings are coming up on November 5th. Okay, we'll say early November. So I'll be updating this every quarterly earnings. Financials are great. Good liquidity, good leverage, risks, macro risk, same risk every other auto manufacturer has, right? And Stellantis has been managing that pretty damn well as they are catching up to Volkswagen and Tesla year to date. So they seem to be managing risks better than their comps. Catalysts, pushing into the electric vehicle market, given their ample liquidity and very low leverage. And then potential trades, well, they have a good dividend. They're going to repurchase shares. It's a long-term investment. So maybe you want to do shares. Maybe you're eyeballing those long-term calls. Completely up to you, right? I think that's about all I wanted to cover. So that's my take on Stellantis. If you have any questions, any comments, drop them below. By the way, if you want to look at the annual financial statements, look on SEC.gov and search for the 20F since it's a foreign filing, right? So make sure you search 20F if you want to check out their annual report. Just let me know what your comments are. If you haven't checked out the other videos, I strongly encourage you to, especially the one I posted last week. It's a lot shorter, and it gives an overview of the four main steps to my stock analysis and valuation. Plenty of other videos to check out if you're interested, if you have time, if you're bored. Any comments, questions, let me know down below. And that said, I will see all of you in the next video. Cheers.